We're going to cover today financial accounting. It's a unit that is undertaken by CPA students, ATD1 and ATD2. So we're going to start with our topic number one. In topic number one, these are the items that we expect to cover in this topic. So the first thing you're going to cover in topic number one is definition of some terminologies that are very relevant to financial accounting. The first one is bookkeeping. We're going to define bookkeeping, financial accounting. And then number two item under this topic is the importance of accounting. Why do we need to study accounting? And then we also examine or look at the uses of accounting information. And then number four item that we're going to examine under this topic is accounting theories. We're going to look at what we mean by international accounting standards, accounting concepts, or stroke principles, stroke conventions. And then we're also going to look at the qualities of a useful financial information, source documents, books of prime entry, and the ledger and trial balance. So these are the items that we're going to cover under topic number one. So by the time we reach at the trial balance, we'll have finished topic number one, understand. And then this will be accompanied by the same notes. So without wasting time, we are going straight away to look at what we mean by bookkeeping. So what is bookkeeping? So bookkeeping is the activity of recording business transactions in the books of accounts. It involves recording of business transactions in the books of account. So when you talk about bookkeeping, we simply mean you're recording transactions in the books of account. And what is financial accounting? Financial accounting goes beyond recording. So it is recording, classifying, and summarizing accounting information, reporting the same through financial statements for decision making. So financial accounting goes beyond recording. So we can define it as the activity of recording financial information, classifying, summarizing, and reporting through statements such as profit and loss, income statement for decision making. So recording, it involves recording, classification, and then summarizing and reporting financial information for decision making. We report it through financial statements such as profit and loss account, statement of financial position, and cash flow for decision making in the organization. Now, let us also look at the importance of accounting to a business entity. Why do we need accounting to a business entity? There are quite a number of reasons as to why we need accounting. It is true that we need accounting in business entity. Business runs the economy of a country. So for that, we need financial accounting. Why do we need it? Number one is to evaluate to evaluate a business performance. So we want to know whether the business is making profit or loss. The only way we can be able to tell that is through financial accounting, because it is the only tool that we have that can summarize incomes. It can give us the total expenses, and eventually we can be able to tell from that whether the business is making profit or losses. Number two, it helps a business to stay within the law. How? See, the businesses operate within a particular territorial governance, which require them, they pay taxes. So now for you to accurately pay taxes, you need to have a system that will assist you collect your data and be able to determine the profit or the loss that you get, so that you're able to pay taxes accurately and therefore stay within the law. So you find that accounting helps us to stay within the law by giving us a platform where we can be able to determine our profit or losses from the profits that we be able to record to determine our profits. And then for decision making, either to expand the business, to hire more staff, to close a particular product, or to close a particular branch. For us to be able to make those decisions, we need to have financial data. So it helps us in making decisions, whether to hire more staff, whether to acquire an asset. You cannot be able to acquire an asset or make any decision without particularly having financial data. And then it also gives us a way in which you can be able to communicate to external stakeholders. These are people that are not there in the running, day-to-day running of the business. We need also to communicate to them. And the important communication that we can have with them, we're talking about the owners of the business, we call them shareholders. They want to know how the business is faring. So now we need to communicate to them through financial accounting. It also helps us in planning. We can be able to use the data, financial data, for planning, budgeting, and forecasting. So we need those data for budgeting and forecasting. So that is the importance of financial accounting. So briefly also, let us look at the users of accounting information. Who are these people who are interested in financial accounting information, and for what reasons? Why are they interested? What is their use of this information? So we're talking about the owners of the business. So we have three forms of business ownership in Kenya here and mostly in the world. Number one is what we call sole proprietorship. That is a business owned by a single individual. We also have a partnership, a business that is owned by 2 to maximum of 20. And then we also have a company, a business that is owned by many people. So these owners of the business, be it a sole proprietor, partnership, or a company, they are interested in knowing whether their business is making profits or losses. Profit or losses. So the owners are interested in knowing whether the business is making profit or losses, and they can only be able to tell that through the financial information. The customers are those people who consumes the products or the services provided by an entity. So they are interested in knowing whether, they're interested in financial information in knowing whether there will be a continuity in provision of products or services. And when an entity is near a particular community or neighborhood, there are advantages. Those products are not as costly as when they are far off. So they are interested in knowing whether the business will continue being there so that they continue enjoying their services or products at a very favorable cost. And then suppliers, these are individuals or people or companies that supply goods to the business, mostly sometimes on credit. So these suppliers, they want to know if they supply their products to this business, to this organization, will they be paid? So they're interested in this finance. They only be able to tell the ability of the business to honor the obligations through analysis of their financial accounting. So the ability to tell whether the business, if they supply on credit, whether there will be a payment. And then managers are those people who run the business on day-to-day basis. So management involves planning, coordination, decision-making, staffing, etc. So they want this accounting information for decision-making, mostly for planning, okay? So they want this information for planning, for decision-making. For them to be able to know whether they can enlarge the business. They are the one who runs the business. So they want this information to make decisions. Lenders are those people who provide capital in form of loans to the business. So they provide loans and they want to know whether the business has capacity to repay back when they are given loans and whether they qualify to be given loans. So lenders are banks, financial institutions that gives loans to the businesses, and they're interested in financial information so that they can see the strengths and the ability of that entity to repay when they lend to them. And then we have another stakeholder, we call it government. The government could provide a conducive environment for businesses, and in return, they would like taxes from the businesses. So they're interested in financial information. It's through the financial information where the business can be able to tell, where the government can be able to tell whether the business are paying taxes accurately. So the government want to estimate the amount of money they're going to receive from taxes from businesses, and therefore they're interested in financial information of any business entity. And then we have financial analysts. These are people who advise investors whether to invest in a particular entity or not. So for them to be able to give that advice, they need to have this financial data so that they can give accurate advices. Accurate advices accurate advice on whether to invest or not. Employees are people who works for these entities. These are people engaged for a pay to provide services in return for payment. So if you're employed in an entity, you'll be interested in their financial information. Why? So that you're able to tell whether your job is secure. If an entity's financial data is showing losses consistently, then you need to have a plan B to exit because your job is at risk. And number two, it can also be a tool for you to bargain for a better pay. If the entity that has engaged you for services, for employment, is making profits, you can use that one as a tool for you to bargain for a better pay. You can reason out that the entity is growing in terms of profit. Therefore, you as an employee also need to be growing in the same proportion as your organization. So these are the users of financial information. So let's look at the international accounting standards. What are the international accounting standards? International accounting standard, it's a set of practices and policies used to systemize accounting function. So we have policies internationally that are used to systemize or to make accounting function uniform across the world, in all the nations of the world. That is what we call accounting standards. So there are policies used to make the accounting function same across the world. Therefore, now we're going to look at the accounting concepts, convention, or principles. So these are the specific policies, from this, a variety of policies from the international standards that an entity selects for their specific application in the entity. So they are specific. These are general. International accounting standards are general policies. And accounting concepts or conventional principles are specific policies from the international standards that are selected by an entity to apply in their financial accounting when they're preparing financial accounting. So we're looking at the accounting concepts, and we're saying these are the specific policies from the international accounting standard that are selected by an entity to be applied in the preparation of their financial statements. So the first one that we want to look at is what we call the going concern concept. So what does it mean by the going concern concept? So this means that a business entity is formed to continue in operation indefinitely. The business is not formed with the purpose to come to an end just immediately. A business is formed with that objective of continuing to operate in the foreseeable future. So when we're preparing financial statements, when we evaluate or examine the financial statement, we know that this business is still in operational. So that is the mentality in preparation of the financial statement. So when you prepare a financial statement, we know that the business is not coming to an end. The business is still in operational in the foreseeable future. So that is what is called the going concern concept. So the business is continuing to operate in the foreseeable future. It does not intend to curtail its operation. So the business does not intend to curtail its operation. It is there to continue in operational in foreseeable future. That is what we call the going concern concept. Then number two is what we call the accrual concept. Sometimes also called the matching concept. So what is the accrual concept and the matching concept? So this concept said that revenue and cost must be indicated in the financial statement in the period in which, if they are cost, in the period in which they were incurred. If they are revenue, in the period in which they were earned. So it means when you incur cost in a particular year and you don't pay that cost in that particular year, you still recognize it in that year. You don't recognize it in the year when you paid for the cost. For example, if you incur cost on electricity of around 100,000, this is the total amount that you're supposed to pay on electricity. And that particular year, you only manage to pay 80. So 20,000 is still not yet paid for. And you pay it in the subsequent year. It doesn't mean that now you recognize the 20 the year that you paid. You recognize the 20, the entire 100 should be recognized in the year that they were incurred, whether paid for or not. And the same as revenue. When you earn revenue in a particular year, you should recognize them in that particular period. In respect of whether you'll be paid in the subsequent, you can earn revenue and the payment comes not immediately. It comes after some time. So the accrual concept, that is what it states. Then we have number 3, what we call the prudence concept. Prudence concept, where it states that where alternative procedures are possible, the one selected should be the one that gives a most cautious presentation. So when we are presenting financial information, we should present them in a most cautious way. For example, when we sell products on credit to customers, we call them credit sales or debtors. So we should not recognize the entire amount from debtors. We are aware from the business experience that a portion of the debtors will not pay because of different reasons. Some might not pay just because of they are unscrupulous, they are unfaithful. Others will be declared bankrupt. So now when you're presenting your financial information, you need to take into consideration that some debtors will not pay. So you provide for. So you less the amount that you expect from. So you present your financial information in such a that in a cautious way, not to overstate your incomes. Like you have said, you also need to take into consideration the loss of value of assets. When you buy an asset, it doesn't stay the same throughout. It loses value. So you need that loss of value need to be taken into consideration through depreciation. So you provide for depreciation, you provide for the loss, for the expenses that are likely to occur. So you present your information in a more cautious way, not to overstate your incomes, not to overstate your profits and income. Number 4 is what we call the consistence concept. The consistence concept. This concept states that in preparing accounts, consistency should be observed in respect of similar items should be treated similarly. Similar items should be treated similarly. And when you choose a particular method of accounting, you use it from one financial year to another without changing. For example, we have different methods in which you can be able to value our stocks. So when you choose a particular method, for example, what we call weighted average, that is your method that you use to value a stock. It is the same method that you should be using from one year to another. You should be consistent because these methods give different results. So you should not use one method this year and another method next year. No. When you choose a particular method, you apply that method consistently throughout. Another method, for example, method of providing for depreciation, we have various methods. We have, for example, straight line method. We have reducing balance method. So if you select reducing balance method as your method of providing for depreciation, you should apply it from year to year. That is the principle of consistency. You should apply that method from one year to another. And then there is what we call entity concept. Entity concept states that there is a distinction between the owners of the business and the business. There's a distinction. You must separate the ownership and the business. So you should not treat the business the same as the owners. The business is a distinct entity from the owners. These are two different personalities. So when you're dealing with the business, you're not dealing with the owners, you're dealing with the business. If you're dealing with the owners, you're dealing with the owners, not the business. So that is the separation between the owners and the business. That is what it means by the entity concept. And then there is what we call the money measurement concept. This one means those items that are captured in financial statements, they should have monetary value. We can be able to measure them in terms of money. We can attach the monetary value to it. Those items that you cannot attach monetary value to it should not be reported in the financial statement. For example, you can have very loyal staff, loyalty, or hardworking staff, but there's no way we can be able to attach a monetary value to the loyalty or hardworking. And therefore, loyalty should not be captured in the financial statement. We only capture items that can be able to have monetary value in financial statement. And then there's what we call materiality. Materiality means it is an item or those ones that are items or figures indicated in financial position, those ones that can be able to influence a decision. They can be able to influence a decision. they can be able to influence a decision. So something is considered material depending on the size of an organization and the nature of the organization. For example, if an organization is dealing with billions of money, and it happens that we cannot be able to locate only 100,000. So the organization is handling billions. It reports in terms of billions. And then 100,000 is the one that cannot be able to be located. So this one is immaterial. You do not waste time on the 100,000 because it's material. I'm using this marker pen to write on my board here. So this is a very vital item to me when I'm writing. But when now, for example, I'm no longer doing this business, this item is immaterial. This item is immaterial. I will not be able to follow it. I want to know how much is it. It is immaterial. It cannot be able to influence any decision. It is immaterial. So we only record items that are material to an entity. Materiality depends on the size of the organization and the nature. And then we have the duality concept. Duality concept, it means that every transaction has two folds. Every transaction has two folds. In other words, we have a debit and a credit. That is the basis of double entry. A debit and a credit. We'll learn what is a debit and credit. So it means every transaction must have a debit and credit. That is what we call duality concept. Then number 9, we have substance over form. So this one means transactions should be recorded in the financial statements in accordance to their substance and economic reality and not their legal form. Not their legal form. So you record them in accordance to their substance and not according to their legal form. For example, when you acquire an item of fixed asset or non-current asset on hire purchase basis, the legal form of that item is that until when you pay the last installment, it does not belong to the entity. But when we are recording, we don't recognize, we record the value of it in the books. We record the value for it, but according to the legal form, it is owned by, we recognize it as the value it is being attached to it. We don't recognize it in accordance to their legal reality. The legal reality is that item does not belong to that entity. But we record it in accordance to their value. So the principle states that transaction and other events that occurred for presentation in accordance with their substance and economic reality, not their legal form. An uncurrent asset on hire purchase, although it's not legally owned by enterprise, until it's fully paid, it's reflected in account as an asset. So we are saying we reflect this as an asset in the books of account, although not owned by an enterprise, until the last installment is paid. So those are what we call the accounting concept. And then now let us briefly look at the qualities of a useful financial information. So we are saying the qualities of a useful financial information. So number 1, this information should be understandable. It is information that someone can be able to read and comprehend. So read and comprehend. Read and comprehend. So you should be able to understand. It should be understandable, and then it should be relevant. Information is relevant if it can assist you to make an economic decision. Information that is not relevant is not important. It is information that can be able to influence you making a decision. And then reliable. Reliability means the information should be free from material misstatement. It should be presented faithfully. It should be complete, and it should be free from bias, personal opinion. Bias means personal opinions, free from errors, material errors. And then the information should be comparable. We can be able to compare it with time, do trend analysis, and be able to analyze from last year, next year, and like that. So information should be comparable. So these are what we call the useful of accounting information, and usefulness of qualities of a useful accounting information. So we need useful information. Why? So that we can make useful decisions. So if the information is not useful, then our decision will be not sound. So that is, now accounting is a system. Now we go to the accounting itself. Accounting is a system. We start with the source document. We go to the books of original entry. We transfer the information to the ledger accounts, trial balance, and the statement of accounts. So that is how it moves. So now we start the real accounting here on what we call the source document. So what are the source documents? Source documents are those documents that shows the evidence of a transaction. So they indicate that a transaction has occurred. In accounting, we don't verbalize things. We prove things. The documents are the mouthpiece in an entity. So when you do a transaction, every transaction that you're doing as an accountant should be supported by the source document. This is a very important document. Number one, we are talking about the invoice. So the invoice is issued in instances when sales are made on credit. So we can sell to our customers on credit, that when you call it outgoing invoice, or you can purchase on credit, that is called incoming invoice. So what is an invoice? It's a formal demand note for payment. So it originates from the seller to the buyer, requesting the buyer to pay for the goods that were sold on credit. So it has a brief description of the goods that were sold, the quantity or the services that were offered, the quantity and the value, and to remind the buyer of the date that they are due for payment. So it's a demand note for payment that is issued by the seller to the buyer for the goods to be paid that were sold on credit. That is an invoice. And we're saying we have an incoming invoice and outgoing invoice. Then we have a credit note. What is a credit note? A credit note is a document that is issued to correct an overcharge on an invoice. So you can overcharge an invoice. So an invoice remains overcharged if some of the goods that had been sold are returned back. The original invoice will remain overcharged. To correct that overcharge, we issue a credit note. Alternatively also, when you're making an invoice, an error can occur. Maybe you can overinflate the invoice erroneously. So to correct that mistake, you issue a credit note. So it's a document that is issued to correct an overcharge on an invoice. Then we have a debit note. A debit note is a document that is an open opposite of credit note to correct an undercharge on an invoice. So when you undercharge the customer, it does not mean that the customer will pay the undercharged amount. He has to be given an additional invoice, which we call a debit note, so that he pays the correct amount. Then a delivery note. A delivery note, when you're delivering goods to the customer, the customer will inspect the goods that were delivered and satisfy that they are of the right quality, the right quantity, and of the right type, and then acknowledges. You give him a delivery note. So it's a document that acknowledges receipts of goods by the customer. So it must be stamped by the customer, an indication that he received goods in a good order, and now he satisfied that he will pay for those goods. So a delivery note is a document that acknowledges delivery of goods. It's a document that acknowledges delivery of goods. That is a delivery note. And then a receipt. A receipt is a document that gives evidence of a cash transactions. So when there is evidence of a cash transaction, so it's a document that gives evidence of a cash transaction. So you can either buy on cash basis or you can sell on cash basis. When you do that, you have to issue a receipt to indicate that there was and then there is a petty cash voucher. So this is a voucher that acknowledges payment of petty cash in nature. So when you pay out cash that is petty in nature, you have to show that this money was paid out, where the recipient actually received the amount through signing the petty cash voucher. For example, there can be minor repairs in the enterprise. You call in the person to do the baby electricity fault. And then there is an electrician who is called in to come and check the fault and do the repairs necessary. So that person will be given money. So to prove that the person was given money, he has to acknowledge by signing the petty cash voucher. And he indicates the details, his signature, and maybe his conduct, so that in case we are following up, we can be able to know that so-and-so was paid this amount because of this and this, on this and this particular date. So it's a document that shows a payment of petty nature. And then we have a quotation. It's a document that it's an offer to sell. It is an offer to sell, so it outlines the prices of the goods that are on sale, the quality, the quantity and the quality, the trade terms and payment terms. So it gives an offer to sell and indicating the prices, the quality of the goods, the terms of trade, and the payment terms. Purchase order is an authority to supply. An authority to supply. So authority to supply goods. So when you receive a purchase order, it means that on that particular date that the order has stated and the quantities stated therein should be supplied on that particular date. So when the customer receives a quotation, so he comes in and when he comes in, you give him what we call a catalog. You give him what we call a catalog. A catalog it outlines the item that are on sale. And then he will go through the quotations, he agrees and sends a purchase order, and then the goods are supplied. So this is an authority to supply, it is from the customers. Then we have remittance advice note. So this is a document that accompanies payment. It accompanies the check indicating what that check is paying. So it gives an outline. It tells you that we are paying this and this amount for invoice number this, and that. So those are what we call the source document. That is what we call the source document. So now, once all the information is recorded in the source documents, that information is transferred to the books of original entry. These books of original entry, sometimes they are called day books or journals. That is another name for the books of original. So what are these books of original entries? So they record the source document. So these are the books of account that record the source document. We say the source document is an evidence that transaction has occurred, a document that is issued to indicate an occurrence of evidence. So that one is recorded in the books of original entry. So these books are sales day book or journal. We have purchases day book or journal. We have return invoice or journal, return invoice day books or journal. And then we have return outwards day book or journal. We have journal proper. We have journal proper. We have cash book and we have petty cash book. So the first one we are saying the sales day book. So what is a sales day book? This one records credit sales only. Credit sales only. So it's a book of account that records credit sales only. So every time you make credit sales as an entity, you record it as sales day book. This is the format. It has the date column. For example, here I've indicated the date, details, invoice number, and amount. So for example, if you sold goods to a company called Hotel Limited on 1st August 2022, so you write the date here, then you write the name of the company, Hotel Limited, the invoice number that you issued when you made the sales, and the amount of sales. So it's recorded date-wise, and then you can take totals. You can take totals on daily basis as you proceed. You can take totals and in daily basis as you proceed. So when you're told to prepare day books, you only identify credit sales and record them according to date-wise in these books and get the totals. Then we also have purchases day book. It records credit purchases only. Credit purchases only. It records credit purchases only, the purchases day book. It has a similar format as the sales day book. You have the column for date, details, invoice amount, invoice number, and amount. So when you purchase goods on credit, for example, if you purchase goods from Patel on credit, you write the date, maybe 1st of August 2022. You purchase from Patel Limited, the invoice number that was attached or given out was 2010, and the amount of supply was 1 million. So you indicate there. That is what we call a purchases day book. And then we have return inwards. A return inwards is a book of accounts that records sales returns. So every time customers return goods for different reasons, those goods are recorded in the return inwards day book. So you have the dates, the details, credit note number, and amount. So when the return inward is given, when the goods are returned, a credit note has to be given. Remember, we say that these are the books that records source documents. So for example, now we had sold goods to Wote on 1st August 2022. And Wote, after some days, that is on 10th of August, decided to return some of the goods that had initially been sold. So we're going to write here the date the goods are being returned, and then we write there they are coming from Hotel Limited, and the credit note number that we are issuing is 20,000, and then the amount we indicate there. So all the returns, sales returns will be recorded in this book. Then we have return outwards. This one records purchases returns. It records purchases returns. So the goods that had been purchased, if there's any reason to return them, then we need also to record them. And where do we record? We record them in this book called return out was daybook or journal. Daybook or journal. So the date, the details, credit note number, or goods return note number, GRN or credit note number. So we write the date. For example, we had purchased from Patel on 1st of August 2022, and on 15th of the same month, some of the goods now we decide they are not of good quality or any reasons and are being returned to the same person, to the same supplier. So you write the name there, and then the credit note number issued, and the value of good, assuming that they are 100,000 shillings. So that is how the return days book appears. And then besides that, we also have a journal proper. So we have another book that records transactions that do not pass through other journals, or we can write that the journal proper records purchases and sales of non-current assets on credit. Purchases and sale of non-current assets on credit. So what are assets? Assets are item of value to a business, and we have what we call non-current assets and current assets. Non-current assets are the asset that stays longer in a business, more than one financial year, and we're saying they assist the business to generate income. So when you acquire those assets on credit, we record them in the journal proper. This is the appearance of the journal proper. We have, for example, if the business purchases a motor vehicle on credit from Simba Motors, it has a debit and a credit side. We will learn what is a debit and a credit side. So if it is the asset that is receiving, you debit and you credit the losing account. So we purchased motor vehicles from Simba Motors on credit. So you write there the date. Of course, it has to have the date. You have another column for date when the motor vehicle was purchased. And then it was 2 million. You record under motor vehicles account. And then it was purchased from who? From Simba Motors, you credit 2 million. If you happen to sell an old furniture, the date should be somewhere here. For instance, 1st August 22. 1st August 22. 1st August 22. So you sell an old furniture to Pangani Girls. So Pangani Girls will be the recipient this time. So you debit them, the value of the furniture that you're selling is 50,000, and you record furniture. Furniture is an asset, you credit it. So this is an account that, this is a book that records sales and purchases of non-current assets on credit. That is journal proper. So that is journal proper. We have looked at this and this. And then now here we have the cash book and the petty cash book. Cash book and petty cash book. These ones are ledgers. At the same time, the day books. The day books. So they record cash transactions when you receive cash or pay out cash. So we learn how to record in this cash book when you're doing ledgers. We are saying it acts as a day book at the same time as a ledger. And then we have the petty cash book. Petty cash book records payment of petty in nature. So we'll look at them once we examine the ledger accounts. So we'll go to the ledger accounts. So we have a ledger. A ledger is a book of accounts where transactions are recorded either as debits or credit. Debit is known as DR or credit. So where is the source of information that is recorded in the ledgers? This information is obtained from the day books or from the journals. So from the journals now we record in the ledger. So this is the appearance of a ledger diagrammatically. It has two sides. The left-hand side is called the DR side or the debit side. And the right-hand side is called the CR side or the credit side. So both sides have three columns: date, details, and amount. Date, details, and amount. So when you're recording transactions, so we have types of ledgers. We have the purchases ledger, we record the purchases, and then we have the sales ledger, which records sales. And then other items are recorded in the general ledgers. When you're recording information in a ledger, we observe the principle of double entry. The principle of a double entry states that you identify the account that is receiving, you debit. Account that is receiving, you debit. Accounts gaining, you debit. You credit accounts losing. So in every transactions, we have an account. Account is a summary of transaction. When you talk about an account, you mean a summary of transactions. And all the accounts that you can ever receive in an enterprise or an organization are summarized here. So we have accounts, and these accounts are subdivided into these accounts are subdivided into personal account and impersonal account. So we have personal accounts and impersonal accounts. Impersonal are subdivided into real and nominal. So we have personal accounts. What are personal accounts? The accounts that bears the names, the names of individuals. So the title is the name of individuals. So these are accounts of debtors and creditors. Remember, debtors are those customers we sell to on credit. So all the credit customers, we must open the individual accounts having their names. That is why we call them personal. They have a title of the name, or the suppliers. So this is an account of suppliers and debtors. So we identify account receiving, we debit, and we identify account losing, we credit for personal accounts. For example, if we buy goods from A Limited, we buy goods from A, we must open A Limited here. So A Limited is losing. It's losing to who? To an account called purchases. So you write here purchases. The value of goods may be 10,000. And then here we come here and write purchases. We write here purchases. We say A, 10,000. So that is what it means, double entry. You've credited, the supplier is called A, and you've debited purchases account. It is gaining. So this one is losing. That is what we mean by losing. If we sell to B, for example, the business entity sells to B, B is gaining. So we have a customer called B here. We are going to say here sales, maybe 5,000. And then we open a sales account here and say B, 5,000. So B is gaining, sales is losing. That is what it means by debiting account receiving. In this case, B is receiving 5,000 from where? From sales. That is what we mean by debiting and crediting, account gaining and account losing. We also have impersonal account, as the word indicates. It doesn't have the names. It doesn't bear the name of individuals. This is subdivided into real accounts here, real accounts and nominal accounts. Real accounts and nominal accounts. So real accounts are accounts of assets, fixed assets, tangible assets. Real accounts are accounts of tangible assets. Those are that you can be able to feel tangible assets, e.g. cash, motor vehicle, e.g. cash, motor vehicle, furniture, building, etc. So here also identify the account receiving and you debit. You identify the account losing and you credit. For example, if we pay 10,000 in favor of transport, cash. So the cash is losing. So we'll have here an account called cash. Cash is a real account. So it's losing to transport. So we write here transport. How much? 10,000. And then you open another account called transport here. And you say here cash, 10,000. So cash is losing. So here account losing, you debit. Account gaining, you debit. Account losing, you credit under real accounts. So nominal accounts, what are the nominal accounts? Nominal accounts are accounts of purchases, expenses, sales, and incomes. So you're told to define what are nominal accounts. These are accounts of purchases, expenses, incomes, sales and incomes. So all purchases and expenses are debited, and all incomes and sales are credited. All incomes and sales are credited. So these are the summary of all the accounts that you can be able to get in an enterprise or an organization. So we use the double entry. That is very important. So once you know these ones, it's very key. So we're going to have a question, a demonstrative question, which are in the notes. You'll be able to find that question in the notes. So we said when you're posting the cash book, we we say the cash book is both a day book and a ledger. So we're going to demonstrate using a question of the cash book, how to post in a cash book and how to post in a ledger and to come up with a trial balance. That is our next move. So we're going to use here a question that I've attached to the notes. You're going to get that question in the notes to demonstrate how to record in the ledgers and the 3-column cash book. So this is how the cash book appears. We have the receipt side, the debit side here, or we call it the receipt side, and we have the credit side. So the cash book, we said, it's a ledger at the same time as a book of original entry. So this side of the receipt, or the left-hand side of the cash book, we record the cash receipts. For the purposes of column, we only recognize these 3 that records amount: the discount allowed, the cash, and the bank column on the debit side or the left-hand side of the cash book. And then now we also have the right-hand side of the cash book where we record payments of cash in nature, either through cash and bank. So the columns are also 3, the discount received, the cash, and the bank column. So this is how the cash book appears. So we have a question here we're going to record, and we are saying a cash book is a book of original entry where we record the cash transactions and at the same time as a ledger. So I have a question here, I'm going to read it, and then we do it together. The question is accompanied in the notes. You'll get it there. And then you can be able to review the question using that question. So the question reads, Wambui opened a small business in Mwiki on 1st October 2020. Her transaction for the month of October was as follows. On 2nd of October, opened a bank account and deposited 150,000 and retained 50,000 in cash. On 2nd, paid rent in cash, 13,000. On 3rd, purchased goods for 160,000 from Marwa on credit. And then on 4th, sold goods for 260,000 in cash. 5th October, banked 230,000 shillings. On 9th, purchased office furniture, 150,000 shillings and paid by check. On 11th, purchased goods for 130,000 from Jumbo Traders on credit. And on 12th, hired transport and paid cash, 10,000 shillings. On the same date, sold goods on credit worth 126,000 to buyer traders. And then on 13th, buyer traders returned goods worth 16,000 and were given a credit note. On 16th, received a check of 60,000 from buyer traders. On 19th, purchased goods for 19,000 on credit from Omolo. On 21st, sold goods on credit to BX worth 15,000 shillings. And on 23rd, paid Marwa and company 144,000 shillings in full settlement of the amount owed to them by check. On 24th, withdrew cash 16,000 for personal use. 26th, bought goods for 18,000 and paid by check. 27th of October, that is, BX paid by checks 13,500 in full settlement of their debts. And then on 28th, paid by check Jumbo Traders debt less 10% discount. And on 31st, paid salaries 15,000, water bills 1,700 by check. Required 3-column cash book, number 1, and number 2, make relevant entries in the ledger accounts and balance of the accounts. And number 3, extract the prior balance at 1st October 2010. So now, this question is there in the notes. The notes are incompatible with the teaching that I'm making. So when you're doing this question, following it on the videos, you also open the question, which is also in the notes. So the question now, that is the format of the cash book. That is one of the requirements of the question. So we're going to be recording. When we receive cash, we record on this side. And then we open the individual ledger accounts. So now we're going to record it very immediately and very fast. So on 2nd open, he opened a bank account and deposited 150,000 and retained 50,000 in cash. So the amount of money that we start business with is called capital. So here it is the receipts that we received cash. The business received cash. So you write here they received from who? From capital. You write here capital. The total amount they received cash was 50,000. So you record here 50,000 and bank 150,000. So you have debited here. It's a day book. It has recorded the cash. And it also happened as a ledger. We have debited. And then here you come here and open another account called capital account immediately. Because you have debited the cash, you come here and write here second bank, it was 150,000. Date, details, and amount. And then here you write here the same date, cash, 50,000. That is what we call a ledger account. You've debited here, you credit here. Then second, paid rent in cash, 13,000. Payment, we said you record on this side. So you write here second, rent. He paid rent, 13,000 cash. So you record here cash, 13,000. You come here and open another account called rent account. You open another account called rent account here. You write the date, which is second, cash, 13,000. Double entry. You've credited, you debit. On third, purchase goods for 106,000 from Marwa on credit. So that is a credit transaction. It doesn't go to the cash book. So here you'll open a purchases account here. That one will be a little bit longer. You write here purchases account. So you purchase goods from Marwa. Remember we had said earlier on, purchases are debited. And Marwa is a personal account. It's losing to purchases. So you write here third. You write here third, Marwa, 160,000. And then you open another account here called Marwa account. You open another account called Marwa account. So right here third, you say purchases, 160,000. So you've debited purchases and you credit Marwa. Because it's not a cash transaction, it does not go to the cash book. That is how you record it. And then on fourth sold goods for 206,000 in cash. So here you write here fourth, sales, cash received 260,000. So you write here 260,000. You open another account called sales account here. You open another account called sales account. So it lost. Remember we said all sales fourth, it lost to who? To cash, 260,000. Account receiving is debited, cash is receiving 260,000 from who? From sales. And sales is losing 260,000 to who? To cash, you credit. That is a transaction that occurred on fourth. And then on fifth, banked 230,000. On sixth, on fifth, banked fifth here. So you write here fifth, he banked. Banked means cash lost 230,000 to who? To bank. That is a contra entry. And then you come here and write here fifth. Bank gain 230,000 here. From who? From cash. From cash. This is a contra entry. A contra entry is an entry that is affecting both cash and bank at the same time. So cash lost 230,000 to who? To bank. Bank gained 230,000 from who? From cash. The same thing can also happen. We can withdraw cash for business use. When you withdraw, it means bank is losing to cash and cash is gaining to from bank. That is what's called contra entry. So we are through with that one, transaction on fifth. Then we go to ninth, purchased office furniture 150,000 and paid by check. So here we write ninth furniture. Check paid 150,000. So come here and open a furniture account. We open a furniture account. So we write there ninth bank 150,000. 150,000. On 11th, purchase goods for 130,000 from Jumbo Traders on credit. So he purchased goods from Jumbo Traders on credit on 11th. So you write here 11th Jumbo. He purchased goods 130,000. So you write here 130,000. Then here you open a Jumbo account. Jumbo account. So that is 11th. You write there 11th purchases 130,000. 130,000. 130,000. So you record there. AC stands for account. AC stands for account. On 12th, hired transport and paid by cash 10,000. So you write here 12th transport and paid cash 10,000. So you open another account called transport. You open a account called transport. So you write here 12th cash 10,000. On the same date, sold goods on credit worth 26,000 to buyer traders. So he sold goods on 12th. So you write here 12th buyer 126,000. So you open a buyer account here. You open a buyer accounts here. Buyer account, and then you write he's receiving 12th sales 126,000. Credit, debit. So remember, credit transactions do not go through the cash book. You post them on the individual ledgers. 126 and then and then 13th, buyer traders return goods worth 16,000 and given a credit note. So buyer traders return goods. So that is 13th. You write returns 16,000. So here you open an account called return inwards. Return inwards account. So you write here 13th. Buyer 16,000. Rather than buyer 16,000. And then on 16th, received a check 6,000 from buyer. Received a check of 60,000 from buyer. So we write here, that is on 16th, buyer lost to bank 60,000. So we write here 60,000. Then here you come here and write 16th, buyer, bank gained 60,000. You write here 60,000. On 19th, purchased goods 19,000 on credit from Omolo. So you come here 19th, you write here Omolo, 19,000. Omolo account. So you say here 19th, purchases 19,000. 19,000. And then on 21st, sold goods on credit to BX. So 21st here, you write here 21st, BX. He sold goods to BX 15,000. So you write here 15,000, and then you open a BX account here. BX account, you write here on 21st, sales 15,000. BX 15,000. On 23rd, paid Maru and company 144,000 in full settlement of the amount owed to them by check. So by check. So he paid Marwa. Amount that is owing to Marwa is 160. So he paid on 26th, 23rd here, he paid Marwa, amount owing to them. He paid them by check 144 in full settlement. So we're being told 144 is covering the entire amount that is owing to Marwa, which is 160. So the difference is a credit. So it means the difference is 16,000. So they received a credit of, they received a discount of 16,000 here. So here you come here and write 23rd. 23rd, we write here bank, 144,000. Then the same date, discount received 16,000. Then double entry for discount received will be done at the ledger level. So you've debited Marwa. Then here you come here and open a discount received account. Discount received account. Discount received account. So you write there 23rd Marwa. 16,000. Marwa 16,000. On 24th, we withdrew cash 16,000 for personal use. So amount withdrawn from cash or from bank for personal use or goods taken are called drawings. So 24th here, we write here 24th, drawings. Drawings are any amounts taken from business or personal use or goods taken from business or personal use. Cash 16,000. So you write here 16,000. And then here you come here and open a drawings account. A drawings account. So you write here 24th, cash, 16,000. 16,000. 16,000. And then on 26th, bought goods for 18,000 and paid by check. On 26th here, goods bought for resale are called purchases. So right here, purchases. He bought. So that is payment you record on the credit side. Remember, we said payments are recorded on the credit side of the cash book, so long as you are payment through cash and bank. So the total amount here is 18,000. So you write here 18,000. Then you write here 26th bank, 18,000. On 27th, BX paid by check 13,500 in full settlement amount owed to them. So you write here 27th bank, 13,500. So you come here and write 27th BX 13,500. So the amount in full settlement. So it means 13,500 is covering the entire amount owing from BX. So the other remaining amount, which is 1,500, is a discount. Then here you come here and write on the same discount allowed 1,500. And then you open a discount allowed account here. You open a discount allowed account. So you write here BX. Sorry, there was a mistake here. This discount received should have been credited here. 23rd, you write here 16,000, Marwa. $16,000. It's not supposed to be on the debit side. So here, a point of correction. This was debited. You credit here on the discount received account, 16,000. The BX you've debited. You credited 1,500. Now you debit here 1,500. You write here 27. BX. That is on 28th paid Jumbo Traders less 10% discount. So on 28th here, you write Jumbo. He paid them how much? He paid them the amount owing to them. So that is 130,000. So less 10% discount. So it means he paid them 10% of 130 is 13,000. So he paid them 117,000. So the discount was 13,000. So you come here and write on 28th, he received bank 117,000. The same discount, he offered a discount of 13,000. So you've debited here, you come here and credit discount here. You write here 28th Jumbo, which is 13,000. And then on 31st here, He paid salaries by check, 15,000. So we write here 15,000. And also paid water, which is 1,700 through. So here we're going to have salaries account. And we're going to say here, 31st, bank, 15,000. And you're also going to have a water account here. And then we are going to say 31st, bank, 1,700. So that is the end of our posting. That is the end of our posting. So we have posted the 3-column cash book and we are posting the ledger. So the next thing after posting is to balance off the accounts. What does it mean to balance off the account? To balance off the accounts means to compare the debit side and the credit side in terms of amount, and then you take the differences of these amounts. You write the difference on the side that is showing less amount as balance carried down. So for example, we have our water account here. We have our water account. So the debit side is 1,700, the credit side is 0. So 1,700 minus 0 is 1,700. You write on the side that is showing less amount. Here we are going to write balance, that is 31st. We are balancing off at the end of the month. We write here 31st. Balance carried down, it is 1,700. So 1,700, 1,700. That is balanced. Then here we come to salaries. It's 15,000 minus 0. So here I write 31st. Balance carried down, which is 15,000. 15,000. 15,000. So here is 1,500, 31st. Balance carried down, 1,500. 1,500. So this one is 29,000. So we write here 31st. Balance carried down, it is 29,000. That is balance of 29,000. We come to drawing 31st. Balance carried down, it is 16,000. BX has balanced. We don't have balance here, so you just write here 15,000. 15,000. Return invoice has balance 31st here. You write balance carried down 16,000. 16,000. 16,000. And then here we have buyer 31st. Balance carried down. This side is more than this by 50,000. So we write here 50,000. So here it is 126,000. 126,000. The balance 31st, balance carried down is 10,000. 10,000. 10,000. So we come to sales account. Sales account, the total sales account is, this side is 401,000. 401,000. 31st here, balance carried down is 41,000. So 41,000. So that one is balanced. Come here, Molo 31st, balance carried down is 19,000. Jampo, this is 130,000. This is 130,000. Marwa, 160,000. 160,000. And then we have purchases here. We have account called purchases. Sorry, this purchases here was posted here incorrectly. It's supposed to have been posted here. We purchase goods here. This one is supposed to be 26th here. It's supposed to be bank, 18,000. This one, I'm correctifying this 26. It was posted here by mistake. This one will be now for 1,000. So that one, this one now will be 327. Double entry for the transaction that occurred on 26, you credit bank and you debit purchases here. So 31st here, right here balance carried down, which is 327,000. 327,000. Please take note of this mistake that you have rectified. We had purchases on 26, which you have credited bank and debited purchases. Initially, we had credited in the bank account, in the sales account, which was a mistake. It has been rectified. So 31st here, balance carried down is 150,000. Balance carried down 13,000. This is 200,000. 31st. And then we also come and balance off the cash book. We compare this side and this side. So the totals of the cash book, we compare both sides. We compare both sides. So the cash this side is 310,000 here. So right here, 31st. 31st, total here, 310,000. This is the total here. And then we minus the cash details here. So 31st here, the balance carried down. So you are taking the total cash received minus the expenses. You want to see what was retained. The cash that was retained is 41,000. 41,000. The balance carried down here is 41,000, which is going to give you 310,000. The bank, the total here is 453,500. You subtract, you get the balance carried down of 7,800, 453,500. So we have added this total is 453,500, and then you have subtracted this, the balance is 7,800, is the balance carried down. And then you just add the discount column, 29,000, and then you add here 1,500. This one you don't balance them off. So that is the posting of the balances in the ledger accounts and balancing them off. To balance off means to compare the debit sides in terms of amount and the credit side, and then you take the difference, you write the difference on the side that is showing less amount. That is what you've done. And then you come and prepare a trial balance. A trial balance is a summary of the balances in the ledger. It's a statement that gives us the summaries of the balances in the ledger. So a trial balance here, we're going to prepare a trial balance. A trial balance is a summary of the balances in the ledger accounts. So we're going to have a trial balance here. A trial balance, we're going to prepare it here. So now, if the debit side was the greater side when balancing off the accounts, that balance is called a debit balance. You write it in the side of the debit. If the credit side was the greater side, that balance is called the credit balance. You write it on the credit side. Now here we have water, for example. Water is a debit balance of 1,700. You write here. We have salaries. Salaries is a debit balance of 15,000. The debit side was the greater side. So the balance is indicated on the other side, but it's a debit balance. So you write there 15,000. Then we have discount allowed. Discount allowed is a debit balance of 1,500. You write here 1,500. And then we have discount received. Discount received is a credit balance. This side was the greater side. So you write it 29,000 this side. You go to drawings, is a debit balance. Drawings is a debit balance of 16,000. So you write here 16,000. So we have BX. This one has balanced off. You don't write it anywhere. Return invoice is a debit balance. So you write here returns